Hello, everyone. Soy Luis Roldan, and today with me we have a very special guest, David Garofalo. How are you today, David?
I'm well, Luis. Thank you for having me on.
It's a real pleasure. Well, it's the first time that you are in the channel. Can you bring us your background of in the mining industry? But because you are considered a legend in the mining industry, can you bring us a little bit of your background and where are you sitting today?
Well, I've been in the industry for close to 35 years, and I run a company called Gold Royalty Corp that I listed on the New York Stock Exchange a couple of years ago. But before that, I spent 33 years building and operating mines throughout the world. Most recently, I was the CEO of Gold Corp and led the merger with Newmont, the largest gold merger in history, $32 billion that create the world's biggest gold company by production and market cap. I ran Hudbay Minerals on the copper side before that for 6 years, built a number of mines there, including the Constancia mine in Peru, which is a large-scale copper mine, and then spent 12 years before that with Agnico Eagle as CFO. Agnico today is the third biggest gold company in the world by production and market cap. So I've been very fortunate to have equal parts of my career, both in the base metal and precious metal side, building and operating mines.
Yes, it's good that the Agnico Eagle experience. I saw the chart. It went 10x when you were in that company as CFO. So a lot of experience, long career, as you said. So it's a pleasure to have you on. My first question is why you decided to become part of the team of Gold Royalty Corp. You were in the major league, top CEO of Gold Corp, what is now Newmont, the biggest mining gold producer in the world. What changed your mind to be now on Gold Royalty Corp?
Well, it was an opportunity to found my own company. Up to this point in my career, I came in to run or become part of the C-suite of established mining companies and help them to grow significantly. But this was an opportunity to create something from the ground floor, take it public. I'd never had an opportunity to do that before, believe it or not, over 30 plus years. But also what underpinned that was a firm belief that we were headed for a long-term bullish cycle for gold. But I was also concerned about inflation in the general economy and how that would affect the margins of producing companies. So I wanted to be exposed to maximum leverage to the gold price without worrying about what inflation would do to operating and capital costs at the mine site. And that's created an overhang in the mining equities, in my view. Even though gold prices are close to all-time highs, we haven't seen the kind of response in the producer equities because they're hung by inflation pressures, like any other business in the general economy today.
Exactly. And we are going to touch a little bit in deep of Gold Royalty Corp because I think it's the superior business model to play the natural resource sector and how you are positioning the company out that. But first of all, I would like to bring the conversation a little bit more broadly about the gold sector itself, like the commodity, the gold. In all this economic environment, rates, Fed high, everything that is happening now in the economy, how is going to affect the gold price? Or it's been a 10-year of bear market in the gold space. So what's your perspective now in the gold market?
Well, I think what we're experiencing today has striking similarities to the inflation cycle that we saw in the 1970s and 80s. Back in the early 1970s, the US dollar was decoupled from the gold standard, and we saw a massive amount of monetary stimulus to fund a war to deal with economic challenges of the 1970s. So we saw monetary expansion very similar to what we've experienced since the great financial crisis in 2008, where there's been a coordinated global effort by central banks to stimulate the economy by introducing massive amounts of money supply and free money, effectively zero interest rates for a very long period of time. So that dynamic is quite similar to what we experienced in the 70s. In the 70s, we also had an oil embargo imposed upon us by the Arab world. And today, the oil embargo is self-imposed. We're not buying Russian oil products and energy products. And so that's put constraints in terms of global supply. And that's infected the supply chain and helped amplify inflation as well. So very, very similar dynamics to what we saw in the 70s and 80s, but with one notable exception. Back in the 1970s, global debt to GDP was only 100%. Today, it's 350%. So that is to say that there's very limited latitude for central banks to really raise interest rates dramatically, as the central banks did back in the 70s and 80s to tame inflation. Mm-hmm. So my view is that that is actually hugely constructive for the gold price. Inevitably, the central banks, and in particular the Federal Reserve, are going to have to pivot in the short term and reintroduce monetary stimulus, because of all the excesses that have been introduced into the system over the last decade or so, which has brought debt levels to the level they are. And we're starting to see the evidence of those excesses in the financial contagion experienced by regional banks in the US, and for that matter, global banks as well, as we saw with Credit Suisse. So there is going to be more bank failures in our view because of those excesses, because of the excessive debt in the system. And inevitably, that means we're going to see monetary stimulus again in a very dramatic fashion, because the only way to deal with the debt levels that we have globally is to inflate it away. There's no fiscally responsible way for them to repay the debt at the government level, and certainly not at the consumer or corporate level.
Exactly. You mentioned the similarity with the 70s. The Fed cannot raise enough the interest rate as they did, and there are rumors now that they are going to stay paused for two more meetings and then to start pivoting away. This is because my question will be, what do you think is going to be the catalyst, or maybe it's more than one, are the catalysts to break those all-time highs that we've been touching for 3 times in a row of 2000, 2018 in the gold market?
Yeah, it's a significant dive in real interest rates, and I think that's happening. I think inflation will get worse. I think nominal interest rates will start to decline, and there's a remarkable negative correlation between the gold price and real interest rates. So the lower real interest rates are, the higher gold prices are. That similarity, or that correlation, negative correlation over a period of 15 years since the gold standard was abandoned, is striking. It's a very high, R squared, as statisticians like to say, very high negative correlation. And so I think inevitably we'll see highs that we saw back in the early 1980s, inflation adjusted. Because back in the early 1980s, gold achieved highs at the time of over $800 an ounce. But if you inflation adjust that to 2023, that would be over $3,000 an ounce. So there's no reason that we shouldn't achieve that real all-time high. The nominal highs that we're achieving now, or very close to achieving, are just that. They're nominal highs. They're not the real highs. The real highs would be $3,000 and above. And as I said, the debt levels are unprecedented levels that we haven't seen ever before in terms of percentage of GDP. To me, that means the $3,000 an ounce is actually the start. I think the ingredients are there for a much higher real all-time high in the gold price, well beyond $3,000 an ounce.
That's a very good point. You said a little bit of a price target for gold. The question is the when, right? The when is going to happen. But I'm in your camp. Actually, I really like a figure that I really like the gold history. I've been a student of the gold history for quite a bit. I like it to compare instead with the exchange of US dollars. I like to compare with the SDRs of the IMF, and according to that market, it's already valued at 2,400. The exchange rate between the SDR. So I think we are heading to that direction, as you said. But the equity market in the gold industry is telling another different story, right? They are valuing gold as we are in a very bear market still. Companies, very good companies, generating cash flow, paying dividends, they are 30, 40, 50% below their all-time high. Why do you think is that discrepancy between the gold price?
Yeah, there's a couple of reasons for that, Luis. So one is that, as I said, there's cost pressures. These companies, the mining companies, are not immune from inflation we're seeing in the general economy. So they're seeing cost pressures in labor and energy in particular. 60% of on-site costs at a mine are labor and energy. And we've seen significant inflation there. So that's eaten into their margins even as the gold price has gone up. So that's created an overhang. The other dynamic that I think is extremely important is that the industry is shrinking. If you look at reserves globally in the ground, they're down 40% from their peak in 2012. The industry simply has not been reinvesting back in the ground in exploration to replace depleting reserves, and hasn't done so for over a decade. And that downward trajectory is unlikely to reverse itself anytime soon, because from discovery to first production typically is 15 to 20 years. So the lack of exploration is going to have ongoing effects on reserves, negative effects on reserves and production for the foreseeable future. That's why today you're seeing so much merger and acquisition activity in the gold space and in the mining space generally. Because if you're not finding it in the ground, you're going to have to buy it to replace declining reserves and production. That's why you're seeing the industry effectively cannibalize itself.
Yes, exactly. You have to grow the business. I mean, mining at the end, you take a ounce from the ground, you have to have another mine to generate revenue for the business. And that's going to lead to a question that Amir and Nani, the partner of yours, bring a really nice business model that has done made before with Ross Beatty and Bob Quarterman in copper and silver, that is accumulating gold ounces in the ground during the bear market for you are co-chairman of gold mining if I'm correct. So I would like to tell me a little bit about that situation, but yes, a little bit of the background about that business model, because I believe it's a genius business model and no one is paying attention to that.
No, look, it goes back to the theme I mentioned earlier on, the underinvestment in exploration and mine development in the sector, which is why they're buying each other out, why the producers are merging to replace declining production and reserve profiles. What Amir has done with gold mining is assemble a collection of development stage assets within the Americas that collectively have over 32 million ounces of gold equivalent in them. Those pipeline projects are scarce. The producers are going to need them. Once they're done eating each other up like Pac-Man, they're going to have to start to build again. They're going to have to start to explore again. And Amir bought these assets at the bottom of the cycle, 10 cents on the dollar, and he just waited for the market and the cycle to turn. And now those assets are having their day. And the creation of Gold Royalty was part of that thesis. We wrote royalties on all of those dozen development stage assets, and then use that as the basis to go IPO Gold Royalty back in March of 2021. And we raised $90 million US, which put us in an excellent position to start consolidating a fragmented royalty industry. So today, we started with those royalties on those 12 development stage assets. Today, we have over 220 royalties across the Americas. And we've been able to achieve that through consolidating a whole bunch of other royalty companies in the sector, but also providing project financing solutions to some of the smaller developers and explorers and taking royalties back, buying third-party royalties, and creating our own royalties organically by staking exploration claims, farming the properties out and taking royalties back. So now we have a very well-diversified portfolio of royalties within Gold Royalty across the Americas, with a heavy concentration in the three best jurisdictions in the world: Nevada, Quebec, and Ontario. They have great mineral potential, low political risk, and low regulatory risk. And we have the highest compounded annual growth rate in revenue in the entire royalty space of 60%, right through to the end of the decade. Yeah, that 60% when you mention sometimes on interviews, it's crazy. And I think some people don't realize 60% on revenue growth is a lot. This is like software companies, and it's a company that has been created in 2021, in March 2021, as you said. Back in the day, I did a video about the company and exposing. This was like April of 2021, and I created an Excel. I'm going to share for the audience, and maybe you can see. This was just what I did one day after the IPO or something, that all the royalties, maybe it's wrong. I mean, I did it just to see what's the value, the real value of Gold Royalty Corp. And I'm saying this company maybe in 5-6 years is going to have 60 million in revenue, which it's quite a lot, the revenues. And companies are trading at very good multiples. And I mean, this company is really undervalued in
in the market. And now that you are going to start producing those kind of revenue, people are going to realize, okay, these mines that they have the royalties on, yeah, they are good companies, right?
Yeah, you know, the seniors in the royalty sector, whether it's Franco, Wheaton, Royal Gold, they're typically trading at 20 to 30 times of their revenue.
Yeah.
And the other attractive aspect of this model, the royalty model, is our very low operating costs. We have 8 full-time equivalent employees to manage the 220 plus royalties that we have. We could run a business with 10 times the number of royalties with the same number of employees. So every incremental dollar of revenue growth goes right to our bottom line and increases our ability to pay dividends. We already pay a 1.8% yield, but I think that we're in a great position to increase that dividend over time as we crystallize that revenue growth. And the other really attractive aspect of our model is all of our royalties are completely bought and paid for. We have no capital calls. We never spend any money on exploration. We just hold the royalties and then we harvest the return as gold is produced from the mine. It's top line exposure. We get a percentage of the revenue. We don't worry about costs at the mine site because we don't contribute to the costs. We just take a percentage of the gross revenue from the mine once the gold is produced. And because we own those royalties, we just have to wait and collect checks.
Exactly. It's taking leverage to a gold price, no taking operational risk, no exploration risks, just collecting.
But we get the leverage to the exploration of our operating partners. So,
exactly.
For example, last year, our operating partners invested over $200 million in exploration on their properties, on our areas of interest where we had royalties. We contributed nothing to those exploration budgets, but we got the benefit of their exploration success because our royalties extended to the growth in reserves that they realized through their exploration.
Exactly. And you said a really important figure that companies like Wheaton, Franco-Nevada, etc., they are trading at multiples of 20, 30 times revenue. If your projections are correct in the presentation that they will be, let's say 15, 60 million in a gold price of 17,000, that puts us in a 6.3 in almost $2 billion company, $1.5 billion company. At what's your current market capitalization now?
It's about $320 million.
320 million. Yeah, that's crazy valuation. You started at $5 and the share price has declined a lot while your value has increased, your fundamentals. So that's very interesting. Something very, very good about Gold Royalty Corp is about your company is the rapid growth it has had since the IPO. You started with 17 royalties. Now it's more than 200 royalties. So it's quite incredible. Exactly. One thing that I would like to mention, because Gold Royalty Corp, I aim for the listeners to go to the website and search and do their own due diligence for the company, but it's very well positioned to take the leverage to a gold price. And you said something very interesting, David, that the producers are starting to do mergers and acquisitions to take those depleting ounces in the ground. And in my career, I haven't seen something of what I'm going to show you in the screen here. Is and coming back to Gold Mining Inc. Is because I've never seen a company trading at an EV per ounce which is negative. I mean, usually the multiple, and you can see better than me, what is the typical merger and acquisition multiple that companies are paying for an ounce in the ground?
Well, for development stage assets, it can be upwards of $100 an ounce. And you're right, because of the marketable securities that Gold Mining owns in Gold Royalty and US Gold Mining, the company they just IPO'd, basically you're getting 24 million ounces of remaining reserve and resource for free.
Yeah.
Within Gold Mining, because the marketable securities exceed the enterprise value of the company. So there's a huge disconnect in valuation, not unlike the disconnect that we see at Gold Royalty in our valuation relative to the underlying value of our assets. And we have tremendous royalties. Not only do we have 200 plus royalties, but we have royalties on 3 of the biggest producing gold mines in North America, in Canadian Malartic, and we'll be producing in Ontario next year, Côté, and also the underground extension of Goldstrike. These are multi-decade generational assets that have provided foundations for those mining companies that own them. But if you look at Goldstrike, for example, again, on which we have a royalty on the underground extension, that was the mine that built Franco-Nevada into the behemoth it is today. They had one cornerstone assets. We have three of them. So I think what the market is missing is not only the diversity and quality of the portfolio and the growth trajectory, but also the foundational elements of our three principal assets in Goldstrike, in Canadian Malartic, and in Côté.
Exactly. And I mean when those constant flagship assets are going to come into production. Let's say it's not going to happen this year, but it's going to happen over this decade, right?
Yeah, well, Canadian Malartic is already in production. As they go underground, right now they're mining from an open pit. We have small amount of royalty on the open pit. We have significant royalty coverage on the underground expansion. They're already producing some small production from the underground, but they'll be ramping up to full production by 2027 underground, at which point we have a significant step change in our royalty revenue from that mine. Similarly, the Côté project, which is under construction currently, it's about 80% built, will be in production by the first quarter of next year. That represents a significant step change in our revenue as well. So we have quite steady growth each and every year, right through to the end of the decade. Ren, we expect, will be coming into production in 25, 26, which again is the underground extension of Goldstrike. That's going to be a significant underground resource with a grade that's almost 7 times the grade they're mining from the open pit at Goldstrike. So it's likely to be prioritized in the mine plan by Barrick and Newmont very, very soon. So very, very fortunate to have these quality assets operated by well-capitalized operating partners, have the balance sheet and the technical wherewithal to deliver these projects on time.
Exactly. I mean, the disconnection between the value that gold royalty has and the price is quite enormous. As we said, we are like in the bear market until gold sector breaks out the all-time highs. We both believe it's going to happen. The question is when. I really like that Gold Royalty Corp and gold mining are very well positioned. I would like finish that. I would like to ask you a question that I always said. If I bring David Garofalo into interview, I have to ask him if you were given $1 million and you have to deploy it into the gold sector, in the gold equity sector, and you come from a finance background itself, where would you deploy it and why?
Yeah, I would take a barbell strategy. And what I mean by that is I would look at different extremes of the gold sector. I would focus on development stage companies that have quality assets and quality jurisdictions. And that's why I'm involved with gold mining, because of the scarcity of pipeline projects, and gold mining owns 12 of them. And that will achieve a significant re-rate as the producers run out of other producers to buy. If they stop cannibalizing each other, they're going to have to start building again, and they're going to need those development stage assets, and they're going to start to trade at a significant premium because of the downward decline in reserves we've seen over the last decade, the scarcity of those projects. There's a scarcity premium that has not been attributed to those development stage assets yet, but when it comes, it's going to be explosive in terms of the re-rate opportunity I see in gold mining. And then on the royalty side, again, what that provides you is optimum leverage to the gold price, to producing mines, optimum leverage to exploration, because our operating partners are conducting that exploration. We get the benefit of that in the royalty as well. And what's been demonstrated is royalty companies outperform when the sector is seeing an appreciation of the gold price. There's inflation in input costs, but there's ongoing exploration. As I said, the producers are going to have to deploy capital in exploration or place depleting reserves. They're going to have to deploy capital in development, and our royalties are going to benefit from the re-rate of those properties through the exploration development efforts of those operators.
Okay, so you are all in gold mining in Gold Royalty Corp. If you were giving,
this is it. I'm pursuing. My career right now is focused on that barbell strategy. I'm not running an operator and developer operators anymore, because my concern is that inflation will result in underperformance relative to the other sector. All the boats will float up as the tide comes in. As the gold price goes up, everybody will go up. The question is, where in the gold sector are you going to get outperformance? It's going to be where there's scarcity, development stage assets, and it's going to be where there's optimum leverage of the gold price and expiration without having to worry about inflation. And that's what the royalty model offers.
Exactly. Well, it's been a real pleasure, David Garofalo. You here. It's been a real pleasure. Thank you, David.
Thank you, Luis. A pleasure for me as well.